And you're still watching Business Daily on Trust TV. Last week, we did see the recapitalization policy coming from the Central Bank of Nigeria, where the CBN increased the minimum capital requirements for commercial, merchant, as well as non-interest banks in Nigeria. And this has, of course, reason quite a number of opposing views as to what this really means and what the outlook for the Nigerian banking sector is. But joining me to, break down all of these in details is an investment analyst, Steve Nwachukwu. Thank you for joining us on Business Daily.
Always my pleasure.
Okay.
Good morning and happy weekends.
Okay, Mr. Steve.
And holidays.
Let us just start off with, the recapitalization policy, like I pointed out. What do you make of this, and what are the potential impacts of this policy, towards the Nigerian banking sector moving forward?
In every policy of government, there are ups and downs. One will say, yes, there are positives of this very policy of the federal government through the Central Bank of Nigeria to strengthen and make our commercial banks more stronger, more liquid, and more better than they were by this process or this very demand or quest for recapitalization. And one will also say, yes, in as much as you want to make sure that the commercial banks are stronger, more sound, and more liquid, you also don't undermine the economic growth of your nation, given the fact that the quantum of money required to recapitalize these about 16 or thereabout commercial banks is in excess of 4 trillion. And where is this 4 trillion coming from? That is what will determine if actually this policy will hurt the Nigerian economy or is going to help foster credit facility system in our Nigeria. Have in mind that as we speak, the credit to GDP ratio of Nigeria is around 14%, which is totally unacceptable, one of the lowest in the world. Credit to GDP ratio around 14%, and we need something above 40-50% so that we can have an even economic growth, expansion, and recovery. So, like I said, you weigh it in one way, or you also weigh it in the left hand and the right hand to actually know if this very policy in the long run will keep the expected expansion, growth, and soundness of the economy that is intended. Yes, it's a good policy, but the timing and the duration and the basket of policies around it, that is what is of concern to most of us. So first, let's take the face value of it. Recapitalization is a good thing to make the banks more stronger, but the intended or the looming liquidity crunch is where most of us are concerned. What it means, this 4 trillion, the banks will be resting and chasing after funds in the months or days ahead, and they will crack the financial credit facilities or credit system. And when they crack, they didn't give opportunity. There won't be opportunity to other smaller or other businesses and companies who also wants to access capital and fund in the same capital market space. So that is the danger. It's going to start in growth because 4 trillion heading towards only a financial sector is a lot. Thank you.
Mr. Steve, you have raised some very valid concerns, and this is not the first time we are hearing, concerns such as this. Economic watchers, analysts have raised similar concerns. But let's talk to, how significant this worries, I should say, or I should call them, are, especially in the area of, access to credit, cost of credit, and the likes. And what strategies should we employ at this point, to minimize the harsh effects of the recapitalization policy?
There is no better policy or better measures than to segment it and make it in sequence. In the sequence that you give a longer time, and just like we have is about 900%, 700%, and 400% increase from those who are licensed for international, national, and regional, which is 500 billion 200 billion and 50 billion. If you check the increment by the percentage, is around 900, 700%, and 400% respectively. So the implication is that you ought to have use somewhere around 300, 200, and 100, or perhaps 150% for each of these very authorization thresholds. Take, for instance, the 500 billion should have been somewhere around 350 billion. That is better, so that you don't crowd the credit financial system. You don't crowd the available resources that ought to have gone into other businesses that Nigerians would have opted. Have in mind that the financial banking sector is not only the source of financial credit facilities that businesses enjoy. We have alternate measures. Like you have the families can raise funds for people. By the time the banks hit the capital market to raise these funds, it means they will grab those available funds that your uncle, your cousins would have easily given to you to start up your business, because they must have invested in these banks, because they'll be giving a lucrative price in their share prices. And also, the community savings schemes that you often see people participate, where people can actually raise funds. What this simply means is that this very rise in capitalization of the commercial banks is going to mop up all available resources in this end. Those who have idle funds that has maybe 1 million, 2 million, 100 million will probably invest in these very opportunities that the banks will be creating by flotation or creating new public offers or private placements to raise these funds. So that is the angle we are much concerned, because the banks will give a lucrative price that will attract existing investors and new investors to invest in them in form of buying their shares. When these opportunities are there, those available funds that should have gone in as a form of alternate credit facility to businesses, small and medium businesses, will be mopped up by this very exercise by this commercial bank, and those facilities will not be available for those small, medium, and entrepreneurs that probably will go to their village head or go to their communities or go to their friends, their family members to raise this very fund. That is the fear. So like I said earlier, it should have been segmented. The CBN should have lowered the percentage required increase in this recapitalization. Like I said, as we speak, is about 900%, 700%, and 400% respectively for each of these cadre. So CBN should have lowered it to somewhere around 500, 300, and 200% increase. That would have been much better, much healthier, and much flexible for these commercial banks to actually embark in this exercise.
Okay, but let's stick with your point now. You raised concerns around, making it flexible for the commercial banks to comply, but still on compliance levels, is an extended timeline of about, I should say, 2 years up until 2026. Do you expect for these banks to meet up with the capital requirements before 2026, or is the timeline also rigid, like you mentioned?
No. Perfectly, the timeline is okay. The timeline is relatively okay. An exercise for 24 months. It's relatively okay, but it should have been done in trenches. In trenches in the sense that, okay, you could have extended the timeline maybe to 6 years, to 5 years. Okay, hit 100% these 2 years, hit another 200% increase in the next 4 years, and hit another maybe 200 or 300% in another 2 years. In 2 years, you are required to increase your capital base or recapitalization by 200%. That would have been much flexible for our commercial banks to do. Like I said earlier,
we seem to have lost Stephen Nwachukwu there. He is an investment analyst, and we're talking to issues around the recapitalization policy coming from the Central Bank of Nigeria, where we did see the CBN increase the minimum capital requirement for commercial, merchants, and non-interest banks I believe Stephen Nwachukwu is back with us on the program. Mr. Steve, can you go on with your thoughts?
Yes, like I was saying, it would have been done in trenches. 200% recapitalization, another 200% recapitalization in 2 years, and another 200% in 2 years. That would have been quite perfect than a stretch of 900% increase in a space of 2 years. So this is where I mean the liquidity crunch may occur, because these banks within these 2 years will be crowding our credit system facilities, raising funds with lucrative prices. Definitely 70 to 80% of this fund is going to come through public offer, creation of new shares that Nigerians will be participating in. Remember, I said that the commercial bank or the financial system is not, the visible one you see is not the only process or the avenue for Nigerians to raise funds to support their businesses. I told you the families are there. There are informal ways. People, even as a company, you can meet your friend to fund your project. You don't need to pass through the commercial bank. By the time these idle funds, probably idle funds, are being mopped up by these commercial banks, it simply implies that these small businesses that cannot access the commercial banks to have their projects or proposal financed will be totally kicked out or shut out of the financial system. That is the danger. Those idle funds, you meet your uncle, you meet your cousins, you meet your community heads, you meet people around you, they can easily raise the money for you. By the time they use those monies to invest in this commercial bank, in this exercise, these individuals, entrepreneurs will be totally shut out of the financial system, and their project can no longer be financed. That is the danger. That's why I said CBN ought to have done this in phases or in trenches. That would have been perfect and healthier for our financial system.
But seeing that the CBN has, put out there and in the manner that it has, not the way you have said it, that is the phases or in trenches like you mentioned, what measures can be put in place now to mitigate the risk that are associated, like the major concerns that you have raised on the program today? What measures would you advise can be put in place to mitigate all of those concerns and dangers, in your words?
I'm very sure that CBN is mindful of politics, and I'm sure they can also. The policy is not sticking rock, in the sense that it should be flexible. They can amend the timeline. They can extend the timeline for commercial banks, given the fact, the issues that we have raised. And I'm very sure that this new regime of the central bank, which is led by Cardoso and his team, they are listening people, and I'm sure they definitely will tinker with the timeline and make sure that this is done. Except 70 to 80% of this money is expected to source from international investors. This is the only where there will be an ease. If federal government through CBN can assist the commercial banks to raise this capital through FDI, foreign direct investment, that will be perfect. But what the risk it will take if you insist that it will be done, or if there is no opportunities for these commercial banks to raise a good percentage of this fund from the international space, it means there will be a lot of merger and there will be a lot of acquisition, and that is not good for our. There will be job losses. Some banks will shut down. If you acquire a branch, that means a good number of some of these branches will be shut down. So we are not expecting such merger and acquisition. Yes, it's part of the options available for these commercial banks, but definitely it is not healthy for us. We need more and more of these players in the market, so that options will be available to invest in Nigerian investing banking community. So,
again, we seem to have lost Stephen Nwachukwu, who is an investment. Go on with your thoughts, Mr. Steve. We can hear you.
Yes, like I said, there is nothing to stop the CBN from actually adjusting the timeline and also adjusting this parameter set by, or the threshold set by this very agency of government, so that they can be much flexible. The question and the best of policies is to be flexible and have a reaching impact in the economy, not when you have good intentions and at the end of the day it turns out it's hurting the economy itself. So CBN ought to realize this, that ripple effect of crowding our financial credit system is very adverse to the economy. You should be mindful of that. The MPR is around 24.75%, and that is already hitting the entrepreneurs, and they are looking for these alternate measures, alternate available measures to raise funds. And when you also mop them up through this exercise, it means that you have shocked at these individuals, and definitely you are going to stifle economic growth, and that is not healthy for us. As we speak, our unemployment rate is one of the worst, and our credit to GDP, like I said earlier, is around 14%, one of the world worst. So government should be deliberate in most of these policies that will broaden, expand, and call or strive for economic recovery of our economy. So this is the angle that CBN should be looking at, and that will definitely be best for the economy.
Nwachukwu, investment analyst, speaking extensively to the recapitalization policy from the Central Bank of Nigeria and the outlook for the banking. Thank you again for your...
Always my pleasure. Thanks for having me.
Where we draw the curtain today's edition of Business Life and Trust TV. Join us on media and other same thoughts. What thoughts on the recapitalization policy coming from the CBN? My name is Chiamaka, Enendu. Thank you for watching, and bye for now.